know what? Oh, I was like, I can't have. Pero la forma que lo hizo. No. You know what I mean? Like, father is here.
And that was like his one job. It was really wealthy.
I think he she's like, what the fuck?
We'd love to get started. So many lovely people in the audience this morning. Thank you guys so much for being here. What's up? Thank you. So happy to see so much good vibes, good hubbub. Welcome, controller. And welcome to all of you. No rush, just find a seat. We want to make sure folks feel comfortable. Yes, it is almost 9:15, so we want to get started. I know this crew runs on time. First, welcome everybody. Give yourselves a round of applause for being someplace like 8:30 or 9 in the morning. After Halloween, if you're a parent, you know that it's been a very busy time. So just shout out to all of the caregivers in the audience. Welcome. My name is Sadie Campo Amor. I'm the Chief Equity Officer for the New York City Controller. It's an honor to be here looking at all of this glorious crowd this beautiful kind of spooky morning. The charge of the Chief Equity Officer is really to leverage the tools of the Controller's Office to advance equity for New Yorkers in every corner of the agency. So in this case, it's the Bureau of Asset Management, but I work very closely with every single department, division, bureau in the agency, and it's a real honor. My role wouldn't be possible without the shoulders that I stand on. So I want to shout out Carl Wallace, who's here today, who is somebody who charted a path for chief diversity officers and chief equity officers everywhere. I'm sort of scanning the crowd looking for you. I know I saw you somewhere. Hi, Cara. Always important to acknowledge the shoulders that we stand on. I also want to thank you all for being here on behalf of 700,000 public servants. This is really an opportunity. Any chance that we can take to talk about diversity and diverse worldviews and bringing different people together in this type of gathering, it's an opportunity and an honor for our city's public servants. Before we get started, often people use the term DEI very interchangeably. Have you guys heard the term DEI? Give me a little hand if you've heard that term before. Right there. Thank you. A lot of you have. Well, they're different words. And so I wanted to do just a quick sort of norming with everybody before we got going today. First, diversity. A mix of people in a room, right? We could imagine a table, all different types of folks around it. That is what beautiful diversity is. And of course, we're here for Diverse and Emerging Managers Conference. So I'm sure that you guys are pretty grounded in what that means. The second is equity. Making sure that those people who are at the table actually have what they need to participate meaningfully and to have equitable outcomes, right? Yes, love equity as well. And then last but not least is inclusion. The intentional thinking that if you are at that table, are you welcome to participate? Do you have what you need to be heard? And that's sort of all of those together are why we're gathered here. And we're really, really thankful. It's really important that this particular conference is somewhat of a living embodiment of that belief system, that when we bring different worldviews together, when we bring different lived experiences together, people from different backgrounds, that all of our city will benefit. And specifically, again, have nearly 700,000 public servants. So we're gonna have some fun today. We're gonna hear some remarks, which are always great. We're gonna go into a panel to hear best successes, and then we'll have an opportunity to network and interact with one another. So without further ado, it is a pleasure to bring up the Controller, Brad Lander. Thank you.
Good morning. It really is great to see all of you in this room. For the room, we're especially grateful to the United Federation of Teachers, on whose behalf we manage $91 billion, the largest of the city's 5 pension funds. So I want to say a big thank you to their trustees who are here today, who I saw, we're right up in front. So thank you, Deb Penny, to Thomas Brown and to Dave Kazansky for being such great partners in general, and for hosting us here today. Don't know if there are trustees of the other funds in the room, but I think they'll be here today. You'll see Allison Hirsch, who represents our office on those boards. The 5 pension funds representing about $250 billion of assets under management. It is the trustees elected by the working people of New York City who are our fundamental partners in doing this work. So thank you for hosting us and being here today. We also want to give condolences to UFT President Michael Mulgrew on a loss in his family, which prevented him from being here today, but he's such a strong partner in this work as well. Thank you very much to Sadie Campoamor, our Chief Equity Officer, for emceeing today and for pushing us hard, not just to talk about the work, but to be about it. Our success won't be having a great conference, though we're looking forward to a great conference. Our success will be if we build relationships that actually take us measurably forward. And that's how we view the work of equity and diversity and inclusion in the Controller's Office. Success requires real action. I'm also delighted you're going to get to hear shortly from our new Chief Investment Officer, Steve Meyer. Welcome, Steve. Like you, our first of these conferences. And also from our brand new Director of Diversity, Equity, Inclusion, and Emerging Managers Strategy, Taffy Ayodele. Thank you to Steve and Taffy. Welcome to both of them. Taffy steps onto the path, let's say, rather than into the shoes that Cara Wallace helped set out for this office several years ago. And actually, in their short time, both Steve and Taffy have already made some critical contributions to this work, and I can see that we're on a path genuinely to move forward. We all join, the two of them and us, we join a great team at the Controller's Bureau of Asset Management. Many folks who have been there, for years, doing really creative and groundbreaking and smart work on behalf of those 700,000 current and future public sector retirees. So will the staff of the Bureau of Asset Management, our asset class heads, our investment officers, our administrative staff, just stand up so folks can see you and recognize you. First, we want to say a big thank you to all of them. But of course, the purpose of today is really for you to meet all of them. And the asset class heads will have sessions later where they can meet funds that are interested in investing in that asset class. But get to know them. It really is a dynamite team. I also want to thank the set of people that organized this conference, which is a lot of work and is a big partnership between the Bureau of Asset Management and our special events team. So will the folks who did the work organizing today stand up? We got our Kate Visconti and Shaquana Cheney-Field, John Adler, our Chief ESG Officer, and then our special events team. I saw Alia Latif in the back and Elizabeth Monterosa. Thank you very much for your work organizing today. But most of all, I'm really grateful to all of you for being here, for being in the room, whether you're joining us online or especially in person. The whole purpose of this conference is to build broader and more diverse relationships so that we can identify talented managers, diversify our portfolio and our business relationship, and move toward our responsible investing goals. And that only works if you're here. So I'm deeply grateful that you chose to be. Thank you. At the Controller's Office, Bureau of Asset Management, our work is grounded in a strong concept of responsible fiduciary investment. That means achieving risk-adjusted market returns over the long term so we can deliver promised retirement security for our 750,000 current and future retirees and make the most effective use of the city resources that we are entrusted with by the people of New York. And taking that responsible investing approach means paying careful attention both to risks and to opportunities. And that means that it's critical to have a diverse set of asset managers. Research shows over and over again that diversity drives strong returns, that it helps you see things you might not see otherwise, both risks and opportunities. Diversity is a proven strength in business that drives both value creation and economic growth. And in fact, investment firms owned by people of color and women are among the best performing managers anywhere in the industry, and in our portfolio as well. That's worth clapping for because it's true, and we're grateful for it. And you'll get to hear from some of the managers who are earning great returns for our members today. And we know that some of the best future managers that we haven't invested yet with are likely in the room, and we are eager to meet you and start building a relationship on behalf of those returns of that future, of those future retirees. In addition to that clarity, we believe that racial equity is a key but too often underappreciated element of our ESG strategy. Lots of folks are clear about the E. Investors are rightly and increasingly clear that climate risk is financial risk. And I'm proud of the way our funds have been long before I got here, but we're continuing it, really taking leadership here to meet a net zero fossil fuel emissions commitment by 2040 and be one of the leaders in pushing forward to a broad global economy that doesn't burn up trillions of dollars in the face of the climate crisis. So that's the E. We're proud to be strong on it. And plenty of folks understand the G as well, recognizing that good corporate governance is essential. We've got a dynamite corporate governance team that, again, I was proud to join, doing really good work on a broad range of critical corporate governance and shareholder initiatives. But I think there's a lot less attention to what that S is really supposed to mean. But just as with environmental and governance issues, inequality is a clear systemic risk in our economy. Not only denying many people of color and women their full and equal opportunity to participate in prosperity, but costing all of us what their full participation would generate. There is just no question that denying people opportunity prevents them from being the ones that come up with the next great idea, with making the next great innovation or invention, and making sure that we confront inequality and more broadly share opportunity is not just good for some folks in this room, it is good for all of us. And yet investor efforts to confront systemic racism and economic inequality are often hidden inside what I sometimes think of as the silent S in ESG. But that is not the case with our office. We really believe that a strong ESG commitment requires attention to a more equal and inclusive economy. And that means on race, that means on gender, that means in the workplace as well. That's why we're proud to be leading shareholders in efforts insisting that Amazon, Starbucks, Apple, and other companies respect their workers' rights to organize. It's important to remember that our funds belong to working people whose union, like the United Federation of Teachers, help secure their standard of living and their retirement security. An economy that builds ladders for its workforce, that does more to promote broadly shared economic opportunity. That's one in which we all do better. And that's true in private markets as well as public ones. So we engage our private managers on these issues as well. Don't be surprised if we ask those of you with a New York City footprint about whether you're participating in CUNY's Future in Finance program, helping young people come into the industry, and in a lot of other ways as well. We're proud of the work we've done to address diversity in the corporate boardroom through our Boardroom Accountability Project, and in the workplace as well through our EEO1 shareholder initiative. 3 years ago, just 14 of the S&P 100 disclosed their EEO1 statements. And thanks to the work of Mike Garland and our corporate governance team and some partners, today over 90 of the S&P 100, and we're going to get to 100, are disclosing their EEO1 statements. And research shows that companies that disclose that data are more likely to close their racial and gender pay gaps and build more equitable and successful workplaces. We can only manage what we measure. And that principle has to apply internally as well to our own efforts to diversify our asset managers. As my mom taught me, if you point your finger, you got 3 fingers pointing back. So for our ESG commitment to be meaningful, we have to live up to it in our work. And just like we demand disclosure from others, we have to expect it of ourselves. So I was surprised to learn that the Controller's Office had not previously published a clear, detailed public accounting of our work with MWBE and emerging managers of our pension assets, or with MWBE professionals in municipal finance. How can we hold ourselves accountable if we don't provide a clear year-over-year accounting of our work toward those goals? So shortly after taking office, I asked our teams in the Bureau of Asset Management and the Bureau of Public Finance to prepare that report. And I'm pleased today to announce that we're releasing the first such report. That's worth clapping for. Come on. Thank you. It details our allocations to MWBE asset managers, managing assets for the New York City retirement systems for our 5 pension funds, the status of our emerging manager programs, the MWDVBE brokerage program for the retirement systems, as well as the efforts of our Bureau of Public Finance to expand their work with diverse firms in our bond underwriting and municipal finance program. It was a lot of work to do it for the first time. So I want to thank Shaquana Cheneyfield, or Shaq, as we call her in our office, Kate Visconti and Mark Pendarvis for their hard work on the report. And Taffy for her contribution to it as well. And you can get it online. We have a few hard copies here, but it is available online today. Here's a few top line takeaways from the release. As of June 30th, 2022, the New York City retirement systems had $16.82 billion in investments with or committed to MWBE managers. That represents 11.65% of US-based actively managed assets, and approximately 7% of the total assets under management for the 5 pension funds. Now, I want to be clear, those numbers are not where they should be. I'm pleased that we're putting them out publicly in detail today for the first time. And I'm grateful for the hard work that a lot of people have been doing over the years to build the good, strong relationships that we have. But I'm not pleased with where we are. People of color, especially Blacks and Latinos, and women remain deeply underrepresented among our asset managers. And I'll speak plainly too, they remain underrepresented amongst the senior staff of the Bureau of Asset Management and the Bureau of Public Finance as well. Part of the work that Steve and Taffy and I are committing to today is working hard to change that. The numbers are somewhat better in public finance, where our office works in partnership with the New York City Office of Management and Budget to manage all aspects of the city's borrowing, including the sale of tax-exempt and taxable bonds to finance our city's infrastructure needs. For 2022, we contracted with MWBE firms for 30.4% of our bond underwriting, 41.5% of our financial and swap advising, and 22.3% of our bond counsel. As those numbers show clearly, and as everybody in this room knows, there are brilliant, talented, high-earning, high-achieving people of color and women across all these fields, and we are eager to do business with more of you. All right, thank you. Yeah. That's the whole purpose of this conference. It's just a starting point, but the goal of today is to grow the number and percentage of our diverse managers who will manage our funds well on behalf of our beneficiaries, to find more financial professionals, consultants, underwriters, and managers, especially today, to work with. And you'll be able to hold us accountable to that commitment, since we'll continue to put the annual report out each and every year that I'm New York City Comptroller. And I hope more other funds will do it as well, because what it ought to be possible to do is to compare how we're all doing and hold us accountable to keep moving forward in the directions that we all need to go. Doing that will help us achieve our goals for responsible fiduciary investing, to achieve better returns in our portfolio, and to do our part to address the risks that inequality poses for the entire economy. So again, I want to thank all of you for joining us today. I really do encourage you to network with your fellow managers as well as with our team. You'll be helping to fulfill your goals and ours. Thank you so much for joining us. Have a really wonderful day today. All right. And it's my pleasure now to introduce to some of you, although I know actually a lot of you know him from either his time at State Street or his time with the Connecticut Pension Systems, our new Chief Investment Officer, Stephen Meyer.
Good morning, everyone. It's a privilege to be here, and I'm grateful for the opportunity to speak with you today. A lot of people have asked me since I've joined as a CIO, and actually today is my 3-month anniversary. I'm certainly hoping this goes well enough that I have a 4th month. But a lot of people have asked me, what have you learned? And I said, I've learned so much. Well, I just realized sitting there what I really learned is I never want to follow Brad Lander to the podium, but I'm going to give it a shot anyway. As Chief Investment Officer for the New York City Retirement Systems, my focus is looking at the pension plans and helping oversee those assets in close coordination with the trustees, as well as the people within the Bureau of Asset Management. Today's focus, as Brad talked about, is understanding that diversity will drive returns, and that we want to ensure that our asset managers are as diverse as the pensioners that we serve. Diverse and emerging managers like you are critical in helping us deliver on our fiduciary responsibilities of generating superior risk-adjusted investment outcomes. The value you bring to the table cannot be overstated, and we want to make sure that you're at the table. There are nearly 800,000 pension plan members counting on us to deliver strong returns. But before I move on, like Brad, I also want to thank everyone in the Controller's office as well as the Bureau of Asset Management that worked so hard to put this on today. It's a lot of work for those that have organized conferences in the past, and it would be nothing but a waste of time if it weren't for the great attendance. So I woke up this morning at 4:30 with the window open. I heard the rain and it was like, this doesn't bode well, but the seats are full and we really appreciate you being here and your active engagement. Regarding the asset class heads, many of you will be speaking with our asset class heads in a little bit later during speed networking. I've been told I can't call it speed dating, but it's speed networking. And the positive outcomes that we seek would not be possible without them. So please engage and spend time with them. Now, maybe talk a little bit about the markets for, well, I'm not supposed to talk about the markets, but anyways, you're all well aware. It's obviously been a very challenging time for our economy and the financial markets and investments in particular. But the diversity across our portfolio, as well as the diversity across our investment managers, is truly a strength. I want to provide you a quick overview of the Bureau of Asset Management. Well, the timing couldn't be, I apologize to those folks from Burrs that are now covered up. Oh, no, not at all. Take your time. This is actually a mid-year snapshot of our assets under management broken down by the 5 pension plans that we have the privilege of supporting. Each one of these plans is large enough on their own to deserve attention. And we have within the Bureau of Asset Management have the honor and privilege of managing the aggregated $240 billion. Again, working very closely with the trustees. Across the pension plans, we help trustees deliver on those pension promises that the controller talked about that are owed to retirees, participants, and their families. It's important work that we're collectively engaged in, and our complete focus on delivering excellent investment outcomes to plan beneficiaries is always paramount. Well, as we all know, there's no guarantees in investing. And this is the aggregate assets of the 5 plans together over the last 12 years. And you can see there's been some really tremendous and nice upward sloping to the right growth up until very recently. And it is our responsibility to work collectively to reinvigorate that process of moving higher in assets under management and that trajectory up to the upper right-hand side. Our focus forward is to restore that upward trend, and we're confident we'll be able to do so. Here's an aggregate breakdown of our assets under management by asset class. And like any large public pension plan, we typically will have a large exposure to public market stocks and bonds. And typically, this is going to drive a big portion of our returns and will be the beta of the market, particularly in those efficient markets. There are also alpha opportunities that we take advantage of in the public space. We also have a growing strategic allocation to private asset classes such as private equity, opportunistic fixed income, core and non-core real estate, infrastructure, and hedge funds. These classes are dominated by actively managed strategies that will support delivering alpha for our portfolios and the underlying beneficiaries. Here's a look at our assets under management in the US, or active assets under management, with a view to the share of managed by diverse firms. I rounded up a little bit and I apologize for that, but as you can see, we have right now 12% managed by minority and women-owned businesses. We can do better. I also call to your attention to the right-hand side, where in certain areas, we've actually done quite well. Public and private equity, hedge funds, and infrastructure in particular. Overall, we can and will do better. Today, we begin the process of re-benchmarking our outcomes. Going forward, we will measure, monitor, and manage and strategize for improved outcomes here. This is important. This slide reflects the performance on our non-directed best efforts, best execution initiatives across diverse brokers. Here we provide our investment managers with a list of our preferred brokers that help execute the transactions that underlie the portfolios that are being managed externally. We can also do better here, and we will work to strategize and put better goals in place to capitalize on these opportunities and initiatives. I should also mention the cash on the bottom is actually internally managed within the Bureau of Asset Management, and will also be something that we'll focus on improving directly. In terms of strategic initiatives, there are several. And again, it's 3 months in. I think I'm still under 100 days, so I'm still formulating some of my ideas around this. But for me, top of the list is always going to be strengthen and develop our team. We need to focus on attracting and retaining diverse talent. We've got wonderful people within the Bureau of Asset Management. We need to make sure that they're challenged, that they're developed, that they're moving up, and they're put in stretch opportunities to really deliver on the promises that are made to those pensioners. We're also initiating something we refer to as our STAR project, which is a strategic and tactical accountability review. When we're doing that in close collaboration with our trustees, that's more of a collaborative effort to determine how do we work best with the trustees and supporting them on their responsibilities for delivering to those pensioners. How do we work constructively with the consultants, and how do we move forward in an efficient way that makes sense for all? We're also looking to fully integrate our ESG and DE&I initiatives into our investment process. John Adler, who you may not be sitting right here, is actually head of our ESG. He's the Chief ESG Officer for the Bureau of Asset Management. He now sits in our weekly asset class head discussions around investments, really trying to embed and incorporate everything that we're doing in ESG within the investment process. We're also looking, as I suggested, to actively engage with our trustees and the consultants and other external stakeholders. It's very important for us to recognize in the room that any fiduciary responsibility that the Bureau of Asset Management has, or the underlying investment managers in these portfolios, it comes from the trustees. They have ultimately the responsibility of overseeing these funds, and we're here to help. We're also looking to challenge conventional thinking while striving for continuous improvement. When I started the first day on the job, I told everyone, I don't have all the answers. I have mostly questions. Well, I still have mostly questions, and that question is why? And I like to ask that to challenge, why do we do certain things? Why do we think certain ways? For example, I think the public pension plan industry as a general matter focuses too much on short-termism. What happened in the portfolio in the last quarter? What happened in the portfolio mid-year? As opposed to looking at where the puck's going. What are we looking at in 5 to 7 to 10 years? We're long-term investors. We're patient. We have patient capital, and we should be thinking longer term. I don't have any conclusions of how we get there, but it's just a thought of where I think we need to go. I'm also looking to promote an investment culture focused on portfolio outcomes. It sounds obvious, but a lot of times we have less than holistic thinking within the teams, meaning more focus on silos versus horizontal thinking about what's best for the portfolios overall. And finally, and most importantly for today, we're looking to strengthen our diverse and emerging manager investment program under Taffy Adioli. If I'm pronouncing that correctly, I apologize. And looking at everything. So Taffy's only been on the ground for about a month, Taffy? Not even, sorry, 3 weeks. And we're really looking forward to her engagement, her ideas, her initiatives to move us forward. So despite market challenges, we're eager to take a positive step towards our diverse and emerging manager programs in the coming year. Together, we will expand the opportunities for and increase the allocations to managers while seeking to maximize these risk-adjusted returns. The New York City retirement system have long valued diversity, and our strong historical returns that we've earned from our roster of diverse and emerging managers proves the point. As CIO, I know the challenges ahead of us are significant, but with a commitment to working on diverse and emerging managers, I know we can move forward in very meaningful ways. It's one of my highest priorities. We will also be working closely with the system's trustees and stakeholders to fulfill this commitment. And before I hand the mic back to Sadie, I want to also encourage you to stay in touch with our office and proactively network with everyone here today. This is a great opportunity for us to get to know you and for you to get to know us, and we look forward to working with you constructively going forward. Thank you.
All right, so we're going to transition into a panel, and as we get folks up, I think we're going to do a little setup. Okay, that's cool. We're going to have a little setup going on. It's kind of like theater, so bear with us. And with the panel is on emerging manager success stories. It'll be moderated by Taffy Iodeli, so we're really excited to welcome her up. We're going to just get these in a little fireside chat style. Love that. Thank you for your help. I also want to acknowledge our controller and Steve, of course, for your wonderful remarks. Give them a little round of applause. That was lovely. Particularly want to shout out that we can't make change if we don't acknowledge it. And so the spirit of transparency and the courageousness that comes with it, even if it doesn't always look exactly how we want right now, is an important and mission critical first step to changing our future. And we're not going to be able to do that without you guys. So I really appreciate that. Panelists, if you wouldn't mind making your way to the stage, and Taffy as well. After the panel, we'll take a short break. You guys can take a little stretch, get a little water, do what you got to do, text a friend, and then we're going to come back together for some breakout sessions for asset class. Oh, you're going to stand up? Oh, great. Okay, well, welcome.
Good morning, everyone. Thank you, Sadie, for being our MC this morning. And I wanted to just really highlight the work that you do to advance equity in the Comptroller's office. We're really, really excited to be working with you. I'd also like to thank Comptroller Lander and our CIO, Steve Meyer, for your dedication to diversity, equity, and inclusion. In the pension and investment management space, it's not easy. It's tough. There are a lot of roadblocks, but as Steve mentioned, this is week 3 for me. And as a member of the newest member of the BAM team, I am proud to say that our leadership team is very dedicated and committed to the work that's going to be required to increase our utilization of diverse and emerging managers. Pulling together our first ever report took a lot of work, a lot of effort. And I want to thank our asset class heads who stayed late nights. And I really want to highlight Shaquana Cheney Field, Kate Visconti, and is Mark Pendarvis here? The 3 of them went above and beyond to make sure that this report came out. So I want to can you just join me in giving them a round of applause? I know they've gotten a lot of applause, but you need it. You deserve it. So there are over 180 diverse and emerging firms in the room today, and about a dozen trade organizations. And I really look forward to working with as many of you as possible in the next coming months and meeting you, getting to know you. Our fiduciary duty really mandates that we invest responsibly, and we cannot uphold that duty if we don't cast the widest net possible. Our panelists today are proof that diverse and emerging managers are some of the top performers in our portfolio. And I would love to now introduce Tammy Jones.
Well, good morning, everyone. My name is Tammy Jones, and I'm the CEO and founder of a firm called Basis Investment Group. And Basis is a diversified commercial real estate investment manager. We do both debt and equity. I love to call it dequity. We've closed over $5 billion, and I'm proud to say that over $1.3 billion is supporting diverse and women-owned real estate qualified investment companies and owners and operators across the United States, a number in New York City, so that's 25% of our business. 78% of our team is diverse, women and people of color, and 50% of our vendors. And I do believe something Sadie said resonated with me, which is things that are not measured do not change. So we have been measuring this, not because anyone asked us to do this, but because it's in our DNA. And I'm very happy to be here.
Everyone hear me from this side? Okay, all right. And next, Bill Potts, would you like to introduce yourself?
Yeah, absolutely. So good morning. I'm a senior partner and a founding partner at the Vistra Group. Today we manage $8 billion in capital. We're currently investing out of our 4th fund, which is $2.6 billion. We're very intentional around our strategy. We focus on the lower middle market, which for us is companies north of 10 million of EBITDA to 100 million of EBITDA. We're vertical specialists, so we really focus solely on education, healthcare, and financial services. And our strategy is really tied to leveraging impact, also leveraging being very active in operations and policy insights to drive performance in the portfolio. So thank you for having us here.
Deanna Hobson. Hi, my name is
Deanna Hobson. I'm Executive Vice President responsible for marketing and client service. I'm also one of the partners of Pew Capital. We have been around since 1991. We are 100% dedicated to active fixed income management. We have flagship products, Core, Core Plus, and Long Duration. Similar to Tammy, I'm very proud of the diversity that we have at our firm. Over 90% of our team represent gender and racial diversity. And that's something that has never been a fad for us. That's something that has really been the DNA of our organization. Very happy to be here.
Thank you. So today's panel is going to be hot, and not just because this room is a little hot. By hot, I mean honest, open, and transparent. We only have about 40 minutes to hear about the learnings and the challenges that came along with you achieving success as emerging managers. And that usually means graduating to direct applications and making significant investments in your people and processes to not just survive, but to really thrive as a emerging manager, as a woman, as someone who's an underrepresented minority in this industry. Really takes courage and resiliency and a relentless commitment to excellence. So I want to hear from each of you, how did you start your business, get into the business, and just tell us the genesis of your respective firms. Do you mind starting?
Yeah, so we started about 10 years ago. For me personally, I was at another private equity fund for 10 years investing in education companies. So I did have a track record in the vertical that I still lead today. My founding partner started a firm in the healthcare space. And another one of my partners built a company with the Pritzker family in Chicago. So we're Chicago based. And so for us, we spent a lot of time in the early days figuring out our strategy. And we're very intentional around the folks that we felt would be the founding team for the firm. And it was very important that we had clarity in terms of how we're going to add value to the companies that we're investing in. And that we're also very clear on impact and how impact is going to drive performance for the company. So today you sort of look at it and it seems clear that those complementary attributes, having an operator, an operational mindset, folks that have financial experience in specific verticals, and then having the ability to bring in policy experts and journeyman business people to really drive performance. It seems to sort of all fit and make sense. But in the early days, we had to be very clear with LPs that this really was our strategy and stick with it and improve it in the portfolio and our performance and what we're doing. So those differences, by the way, is really part and parcel of is a foundational element for us. So it's for us, diversity obviously includes diversity in gender and race. It also includes diversity of thought and skill set. So that's a big part of how we think about adding value and bringing really the best to the table to get to the best answers and drive performance.
Tammy?
Yeah, well, great. So the biggest challenge for Basis, my firm's name, was raising capital. And I think that that's kind of why we are all here. When I started my company, I'll just be, really honest. I always had an entrepreneurial spirit, and I always kind of felt like I wanted to do something on my own, but I was really afraid. I was afraid that no one would believe in me, even though I managed money for large institutions. Some of those institutions included Equitable, a subsidiary of GM, and then I ran a platform for the Case Depot. I had been in the pension fund management business my entire career. I still didn't believe in myself, and I hope I'm speaking to someone out here. But two things happened. You know how sometimes in life you get the heat turned up on you, and I believe that change is good, but the great financial crisis happened. And so the world stopped. It seems like it was forever ago, but don't you guys remember that? And so I was sitting in my office and I ran this platform. I closed 6 billion, had 80 people working for me. And I wrote a business plan because there was nothing else to do. And I literally said, if I had money, what strategy would I embark on? And my strategy was debt, follow the money, debt will come back first. And I saw so many people before me make money in cycles because I believe strongly that, you know, there's opportunity and challenge in down markets. And so, you know, I said to myself, if not now, when? That was the first reason. Second reason was I never saw anyone who looked like me as a CEO in commercial real estate, a Black woman. Imagine that. And I had to create the role for myself. And I said, you know what, Tammy, you still have your MBA. You still have all this experience. And what is the worst thing that can happen? And I'll tell you one quick story. I was reading the book, The Alchemist by Paulo Coelho, and it's like my go-to adult fairy tale. So if you ever need like to be light, read that book. And it said, there was a quote that said, you know, there's only one thing that stops you from achieving your dream. It's fear of failure. And that's what it was for me. And maybe someone out there feels that. But anyway, started my company. The biggest challenge was access to capital. I made a list of my top 10 family office folks that had money because I knew kind of where the capital, we had cashed out a couple of people on the cycle. I knew where the money was. And so got to number 7 on my list and found my first family office investor who gave me 100 million. But there were a lot of no's in that process. There was a lot of second guessing myself in that process. But, you know, Taffy, I love the word resilience. It's my theme word because you have to just keep powering through, right? And so I went from there and just decided to build a track record and to raise capital by strategy. And, you know, that led to entering into some emerging manager programs. And I would say that all of us in this room, you have to understand how to know what you bring to the table, articulate it in a way that institutional capital can understand it and understand how you're going to manage risk, and then build a track record. Come to the table showing what you can do. And we'll talk more about that because I don't want to answer everything in this one question. I'm going to kick it over to you.
So our firm was founded by Mary Pugh and started with one account, 5 million in assets under management. And we were self-funded. So we did not have any outside investors, didn't take out any loans. And I think that really lends itself to the conservative nature by which the firm is managed today. But Mary was really passionate about investing and passionate about fixed income. But I think one of the reasons why our firm is still around is because she's very passionate about client service and very passionate about developing the next generation of diverse investment talent. So while there are many challenges, you know, early on, there was this focus on really shaping the investment manager that we wanted to be, but also the investment manager that we did not want to be. We have to know what you don't want to be. And for us, we didn't have a huge, and still don't, a huge business development team, you know, huge marketing budget. We really believe that if we developed the relationships and cultivated those client relationships and did what we said we were going to do, that clients would stay with us and they would grow with us. And I read recently that 50% of allocators scale their investment over time. And for our firm, we have over 90% of our clients who have increased their allocation over time. And so philosophically speaking, our commitment to that client-centric model has really been what has helped and supported our business development efforts over the years.
I know, Tammy, you mentioned raising capital was your biggest challenge.
Yes.
But what would you say your second biggest challenge was? And I'll let the other panelists kind of chime in on that in terms of your challenge, the challenges you faced.
I think that raising capital was 1, 2, and 3. So, yeah. So, I mean, I think it was, you know, building a scalable core team and really trying to have the infrastructure that's necessary. It's one thing to think that you can do deals and you have the ability to access a pipeline. But when you're coming into the institutional world, it's very different because you have to have a back office. You have to understand how to report. You have to understand, risk and manage risk. You have to understand accounting and treasury and cybersecurity and all of these things that when I mentor diverse managers that come to me, and I'm humbled to do this. I often find myself talking about, reporting and fund management and waterfalls and things that they hadn't really thought about. And so I think building that practice, thankfully, and I think it's great for those of us who were, I used to say I was tucked in the institutional world for a while. It was an amazing training ground. It was the place that I understood, all of the ways all of those various groups came together to bring, the product and to make sure that we were not just looking for opportunity, but we were also managing risk appropriately. And so, I think that's the biggest challenge for most of us, because I think it's us, is really trying to scale and trying to have the money to be able to do that, whether you are self-funded or whether you decide that you want a partner. And I would just suggest that 100% of zero is zero, right? So sometimes you have to actually realize that you may need a partner. Pick your partners wisely, just like how you're investing. But I do think that those were the things that I had to grapple with, which was, I know how this is done. I don't have 80 people anymore, right? I have, I'm doing, everything for a minute, and just realizing that that's going to take a lot of time and money. And then understanding that your first fund, if that's what you decide to do, you're not going to run out and be a billionaire. It's really hard. And so that's how I would describe my next challenges.
Phil or Deanna, do you have anything to add to that? For your
Yeah,
challenges?
I can jump in. I'd say there are two beyond fundraising. Operational process for us. LPs spend a lot of time trying to understand what your strategy is, for particularly in the space that we plan for adding value. And it's for us, it's not just marketing to LPs, but it's really like, how do we have a process with real fidelity? And that takes time. So we fortunately incorporated an operator's mindset in what we do. So what we ask our portfolio companies to do, we actually drink the same Kool-Aid, right? So how do we have clarity and strategy? How do we really kind of leverage the assets that we believe we bring to the table and do it consistently over time? And that's always kind of a work in process. In the early days, it's not going to be as great as you'd like or as tight as you like, because you have sort of a vision around how this is all going to work, and you just keep refining it, right? So we leverage a lot of experts in a lot of different niches, and it sounds easy when you look at it and you pan up at a very high level, but specifically, how does that work, right? How do you get people, whoever they are, to sort of come down and really add value at a $100 million or $200 million portfolio company level, and do that consistently? And so really refining, sort of the flywheel, so that there's real fidelity to that process. Continues to be a challenge, and it was a challenge when we started the firm, and that's a real core for us. And again, how do we layer an impact in that, right? And use it to manage the portfolio. So operational process is a big deal, and we continue to refine that internally. And then the team, just getting buy-in from the team, particularly as we brought in deal professionals from different firms. There's a process that we do that's specific to how we add value. And, folks who are very talented are going to have to sort of refine how they used to do things and retrofit it for how we do our process. And it's very important that we have alignment and culture. Transparency is a big thing. So again, this is not just something we put on our website, but having very candid conversations, being able to talk to people clearly about what you liked in investment committee or not. Those are hard things to live and practice every day, but that's part and parcel of building a team. So I'd say building the right team is also a big challenge, and we continue to work on that.
Yeah, and I could just, an extension of what both Phil and Tammy mentioned is that, when we think about things like operational challenges, and I wouldn't even call them challenges, it was really having that perspective that these are uncompensated risks. And how are we putting those items as part of our strategic plan? So we spent, early years investing in the investment team and that part of the business. But as time progressed, really focusing on the cybersecurity, the compliance, the operation were equally as important. And it actually reminds me of a short story about a client a couple years ago. He was complaining about another manager, and he never mentioned the manager by name. But he was saying how this manager, every time they meet, all they do is ask about, getting additional allocation. And he said, mind you, they have compliance issues, their reporting is a mess, all of these other things are going wrong, but the people were focused on raising more money.
Yeah.
And for me, that was just a reminder that it is really easy to raise more money. And oftentimes you don't even have to ask if you have all of those other parts of the business running
That's a great point.
really well. And sometimes I think we ignore that, but that is a simple explanation of keeping things running smoothly. And then the other thing I would I'll stop there.
So I think all of your points were very insightful, because I could imagine that most of you, can you raise your hands if you're raising your first fund? But now that you've passed that and you're on to probably funds 3, 4, 5, et cetera at this point, are your challenges today any different than the challenges that you had when you started? And can you maybe speak a little bit about what it took to get you there? Like the market environment was very different when you raised your first fund. So what is it looking like today for you?
Me? Okay. She's looking at me. So I'm going to go back, because I think it's important to level set. So when I raised my first fund, it was after doing a series of joint ventures and separate accounts. I wanted to save this part of the story. And I did that because it was the great financial crisis. It wasn't, just to set context, it wasn't a great fundraising environment, as you can imagine. But I knew that I needed to build a track record. So access to some separate accounts and some joint ventures was the way that I got, institutional capital to manage. I was also, looking for some emerging manager programs. I did a few of those. And when I finally had 8 ventures and I had capital for each of my strategies, even though I had this huge attribution record from all the institutional, $20 billion of deals that I did, which many of you may have as well, I didn't feel like that track record was portable and I could just point to it. I realized that I needed to do 2 things. One, even though I had these separate accounts and joint ventures, I decided to do a listening tour. And one of my first stops on my listening tour was New York City. And why? Because I am from South Jamaica, Queens. And you know what? My family is a family of civil servants, police officers, teachers. And I just felt like this is home and I need to talk to these folks. And I didn't ask for money. I asked for help. And I remember talking to John and Janet, and at that time, Yvonne, Nelson, and they were very honest with me about the things that I needed to do. And I thought the conversation was amazing because it took a minute to get the meeting, but once I got the meeting, I just put on my listening ears and I just wanted to know, what would it take? Here is what the story is. Where does the story need to be? And then I worked on it. And it took 4 years, whatever it was, but it just didn't stop there. I started to think about, how can I create a story, is what they told me to do. Build your back office, but also tell us why you're different, why we should invest with you, which I think is really important, because that literally is differentiation, right? And so I entered into a joint venture with Grosvenor in this emerging manager initiative, where I realized that as good as I thought I was and as great as I thought my track record was, I wanted to be able to go in with a seed portfolio that showed investors, potential investors, that it's not just a theory. I'm not raising a blind fund, but I'm actually going to have, 8 investments in exactly what I am telling you that I'm going to invest in. And so once I did that, that was like my catalyst pivotal moment, because I was able to come into New York City and talk to the team and say, here's what I've done. Here are the 8 investments in all of the areas that are the strategies for the fund. So again, seed portfolio. Quick story. There were 2 other diverse managers in a similar space raising money at the same time as me, blind pools, and they didn't get as much traction, but I got traction on the seed portfolio. New York City was my anchor investor, and I'm so grateful for that, and gave me my largest allocation. Actually, I think it was the second largest allocation. State of Connecticut, Steve, was my first, a little bit larger, but State of Connecticut came in much later. But it was the catalytical, transformational first big anchor. New York City came in, and the next thing, it went from there. And then I don't want to take up all the airtime, but Fund 2 was much different, different fundraising environment. But once I had a proven track record in my first, $400 million fund, my next fund, New York City, by way of example, and both State of Connecticut, tripled their investments with me. And I'd like to think it wasn't just because I'm diverse, but I was told that, we were top quartile, and that is what I'm most proud of. And I say that, again, not to brag, but just to say that it's important to, get that first capital, but also to what you said, be about it. Do what you say you're going to do. If you say you're going to deliver these returns in this strategy, don't creep over here and do something else. And so I think the fundraising environment was equally as challenging on my next fund, because I raised it all in the pandemic on Zoom, which is a whole nother story, but I'm going to let my panelists speak now.
Phil, what are some of the challenges today that you didn't face starting off?
Yeah, I mean, I'd say the biggest thing today is still some of the same stuff we were dealing with in Fund 1, right? Which is our operational process. The bar just keeps going up and up, right? So the infrastructure you need at 2.6 billion, little different than the infrastructure for 400 million. How do you stay ahead of the market? We're thematic, and so we always question, are we going deep enough? Do we have the right insights so we know where to play in the right spaces? So really, like, reinvesting in our infrastructure is a big thing for us, and making sure that we're investing in the right areas. One of my partners is here, Mona Sutphin. Mona, you want to raise your hand? Brilliant strategist. Mona's been with us for a couple of years, and so she really helps us go deeper on what themes we want to go in, and to make sure that thematically we're focused on the right areas. And we're constantly trying to figure out how can we add the right partners so that we can stay ahead of where we need to be.
That's great. For you, but in the fixed income space, when your firm started to today, the challenges are obviously very different. Can you speak a little bit to that?
Yeah, so on paper, you would think it's getting easier. So just to give you perspective, because I think these numbers are really interesting. So it took us 14 years to get to $1 billion in assets under management.
Wow.
It took 7 years to get to 2 billion in assets under management, and then just under 2 years to get that 3 billion. So on paper, it looks like, it takes money to get money, as the old adage goes, and that has definitely been the case. But I see my friend Gilbert Garcia in the audience, and we all know that even as you grow, the challenges don't change. And, you think about plan sponsor governance and the challenges there. You think about the consultant community and the growth that it has started, but still has a ways to go. Those problems are real. And I'm happy for the leadership of people like Garcia, Gilbert and the Melody Hobsons of the world, John Rogers, Mary Pugh, for all the work that they're doing. But we have a lot of work to do. And I appreciate even New York City acknowledging the work that needs to happen. But the other thing that happens as you grow is just, there's a tremendous amount of responsibility that we feel like we have. with success comes responsibility. And I say that because, it's easy to get distracted in this business, to think about, how can you grow faster? How can
Yes.
you bring on more assets and all of those things? And we run those kinds of opportunities through the lens of, why did the clients that are with us today hire us? And are we doing what we said we're going to do? And that's such a big part of that evolution, is not losing who you are. And so I think that would be the main point that I would make.
I know Tammy answered this question about what was that like catalyst or pivotal moment that gave you that momentum to raise that first billion? I don't know if Phil or Deanna would like to share what that was for your firm.
I wouldn't say one specific catalyst, but performance helps. Right?
Yeah.
So we didn't raise our first billion until our third fund. And our first funds, we didn't rate, was a $400 million fund. Our first close was 100 million, right? So there was a lot of skepticism. Can you guys do this? And we had to do deals and basically show as we built the firm, kind of show and prove, right? And so once we got the 400 and then the $800 million fund, performance was very good for those first two funds. And I think then, we got quite a bit of momentum after that. So, but there was a lot of work that went into getting those first two funds and the infrastructure and our model and our process kind of up and running. So I don't know if it's a specific, ex post, you might, it may look like there's a specific catalyst, but it's kind of doing the work, building the model and making sure there's real fidelity to your process. Not drinking your own Kool-Aid, being skeptical about attribution, and doing that every day, and then press. Sometimes you got to press. You feel like, okay, we've earned the right to play in this space, and then you press.
Taffy, can I add something? Because you triggered something for me. I think it just takes us longer to get to that $1 billion number, and it's so hard. And I just want to call that out. Point number one. And then, I think, the second point is that we have to make sure that, like, you said about the doing what you say you're going to do, that it's so important that we're able to, to do what we say we're going to do, and performance is number one. But the other thing is having strategy about your raise. And I just want to make sure that we talk about that, because my mother always told me, don't go where you're not welcome. And I use that rule in my fundraising strategy. Instead of banging my head against the wall and going to places where I know they didn't have the statistics that Comptroller just talked about, I analyzed, the entire United States and found CIOs, or people on real estate committees who looked like me, or that they had very woke folks that were allies, right? Who actually, they cared about this. And so I found myself in places like Baltimore, I'm helping you guys out here, Connecticut, the state of Illinois, my beautiful state of New York, and a couple of other pockets. Can't tell you all my secrets. But I would suggest that you have strategy about this. I raised my own fund. I didn't hire anyone. I did, that's why I have a lot more gray hair than when I first started. But honestly, be strategic and go to places where, you can be the pioneer too, but make sure that you don't spend your time. And I did that in my first fund. I spent my time talking to people that I knew had no intention. I probably had 16 meetings with some of these people. And my second fund, I was like, no, I have earned the right to be respected too, and to actually go where it made sense. And so I share that because you triggered, about kind of process and kind of doing what you say you're going to do, and then also strategy. I don't know why it made me think about that. So just wanted to add that in.
That's very good. Conserving your time.
Yes.
Being very intentional.
And that's the word. That's the
Very
word.
intentional. No, I wouldn't add any more than what Tammy mentioned, because I think those points are really great. I think the other thing though is that when we think about that's fine. Sorry, I don't want to keep.
No, it's
In the
okay. I
same
think we have time for one more question. And as you know, I'm head of diversity, equity, and inclusion, but a big part of the work that I do, my team is also in ESG. So I'm curious, as diverse firms, how do you make ESG part of your firm execution? And Bill, do you want to start?
Yeah, we have an impact team. They're included from when we start kind of the teamwork, when we identify a target that we want to acquire, they're part of the diligence. We track very specific metrics. Some are tied to, in education, student outcomes or healthcare outcomes. Some are internal, so DEI specifically tracked in the portfolio. Gender diversity is tracked. Employee engagement. Again, our model is tied to the understanding that progress in these areas will lead to better performance. And so we work with CEOs that are aligned with us on that, and we track all those metrics. Our report was published 3 weeks ago, so I think anyone who wants to pull it up, they can pull it up off our website. And so we publish it every year. Strive to do better, and so that's what we do. Yeah.
So ESG is not good for execution. It is execution to me. And I honestly have believed that. I'd like to say that Basis has been ahead of the curve in this. We've been tracking the S for a decade because this is something that I felt was important. Obviously, the E and the G, as Controller mentioned, have been, somewhat easier to embrace. Our approach simply is ESG. We have an ESG committee, which is my senior leadership team. Every employee is a part of the E, S, or G committee. We have external and internal goals, corporate goals, and then in our investment process, we actually developed a risk rating for each of our investments that have ESG risks and or opportunities. In real estate, obviously climate change, floods, fire, all of that stuff is pretty obvious, but we're also working with our partners and developers, owners, and operators they answer a questionnaire that it's interesting. Everyone said, no one's going to answer this questionnaire. Everyone's answering the questionnaire if you want our capital. And we're getting great data. And some of it's not that everyone's doing everything well, but then we try to talk to folks about things that they could be doing or actually asking them questions that the folks that we're backing and investing with, so they don't even sometimes know that they are doing stuff like LEED certified buildings, energy efficiency. I mean, all of these things are accretive to the bottom line. And we think it's a secret sauce to why our returns are higher than some of our peers. And we care about this. So I think it really is, I'm going to steal your word, intentional. You have to be intentional and you have to get buy-in from not just, the leadership team, but everyone in the company has to be pulling in the same direction. And so we have an ESG report that we issued. We're going to do a second one. And I'm just really actually excited that people understand that it's not just about the financial return, but that over time, these risks will impact adversely your returns.
Yeah, and the only thing I would add is that when we think about fundamental credit analysis, ESG has always been an important part of doing that job right. And so for us, it's never been a separate part of the process. It's how we do good analysis.
I want to just say thank you.
Thank you.
For taking the time out of your busy mornings to share your stories with us, for being so open and transparent with the audience. And I hope that you all have learned a lot from this panel today. I do have to, and can you just help me?
And I would be remiss if I didn't thank you, Taffy, for coming on board and getting this executed. Well done.
Thank you to Taffy.
So I do have some housekeeping to share with you all before we leave this room. We're heading into a short break right now, and We're going to have our asset class breakout sessions. All sessions are scheduled to begin at 10:45. Public markets, which is public equity and fixed income, will be held in this room. Private equity will be held next door in Schenker Hall A, which I believe is to my right. Let's see. Then the other asset classes, private markets, infrastructure, real estate, alternative credit,